Welcome to the weekly update, where I'll go over the action in the market for the week of January 16th through the 19th, and then we'll see how things look for the week of January 22nd through the 26th. On a positive note, in Friday's session, the S&P did set a new all-time high. Now, the Dow has already been setting a series of all-time highs. The NASDAQ 100 has also been setting some new all-time highs. Now that the S&P 500 has done the same thing, we see confirmation. We're still seeing some negative divergences that I'll talk about as I go through the video, but at least on the surface with the main indexes, we are seeing some improvement. We were starting to shift more negative this past week, but then we shifted back to looking more positive, and then Friday's session is really where we saw things take off. It was also options expiration. Before I get started, please note that there is a PDF available in the description below each video that I post. Sometimes folks like to download what you're looking at right now to follow along. Sometimes you can also see the charts a little bit better than if you're watching on a phone or a tablet or something that's smaller. This is just a tool that I make available to you to help you go through and actually not only see the bullet points of what I talk about, but also look at all of the different charts. The pivot points are posted each day on the community tab on the YouTube channel. There are pivot points that last the whole month. I update that every day with the new closing value. And then there are pivot points that only apply to the next session. And those I watch with a 10-minute intraday chart. And that can be quite helpful to see how things are acting. I'm not a day trader, but to get a feel for where are we seeing buying, where are we seeing selling, and that can be quite helpful. One of the things that I teach in my courses and I constantly tell people to do is be watching what's going on all the time. You might not do anything, but just observing gives you a feel for the overall environment, and watching the pivot points may help you to do that. I do have a private Facebook group that you're welcome to join. There's not an awful lot of back and forth in there, but if you want to join and maybe interject some things, ask me some questions, look for some feedback, you are more than welcome to do that. I did already post a new poll for the upcoming week, and I'll be going through the results of the most recent poll here in just a moment. And I did go through right at the beginning of the year, and I deleted some comments. These are comments that people make that I really can't respond to. I can't say I agree. I can't say I disagree. You're making a statement that really doesn't allow for any kind of back and forth to go on. I let those stay up there for 6 months to a year. So usually at the beginning of the year, I go through and delete them. They're mostly attached to the online course that I have available on the YouTube channel. Typically, unless they're garbage comments that I delete anyway, I will respond to comments as I'm posting the daily, weekly intermarket analysis and deep dive videos. Videos are also posted on Rumble. So if I'm having problems, which I do sometimes with Rumble or on YouTube, go over to the other platform and you might be able to find my video there. I try to be fairly consistent with when I post videos. So if it's getting beyond the time, I will usually post something on the community tab, like I'm sick or I'm gone or the power's gone out, although I probably can't post anything then. But I try to be consistent with this. And usually there's a reason when I don't, if you are used to following along kind of the posting schedule that I use. All right, let's go back and talk about what happened. So for the week, we were up 1.17%. Volume was still below average. Now, each day we were above average with volume for the most part, but because Monday we were closed, that chopped off the weekly value, so it looks like we're below average. We are positive with our technicals. We have some extreme positive readings. We have some things to be concerned about. That's always the case. That's my approach to technical analysis. I try to look at everything that is relevant to what's going to impact the S&P 500. And sometimes we're going to see some things that we could choose to freak out about. But then we see some other things that we're like, okay, that's kind of positive. I form more of a consensus based on everything I'm looking at. And at the end of the daily videos, I reach a conclusion, whether we're in an uptrend or a downtrend. I try to have the charts speak for themselves. You'll notice that I don't interject an awful lot of opinions into these videos. Over the years, it's like I don't need to. I look at so many different things. I look at the charts and I let them tell me what's actually happening. But for right now, the market is also fixated on inflation and interest rates. We are going to get the second big inflation report of the month coming up in this next week's Friday session with the PCE prices. They'll be coming out. We're keeping an eye on all the different geopolitical events, but they don't seem to really be having an impact on the market right now. We're dealing with earnings as they're released, and we're starting to really ramp up as far as earnings are concerned. And then the Fed may come out here, there, and give some speeches to either confirm the market what it's already thinking or to try to interject some kind of new scenario into the market. When we look at our trend, we are in a strengthening trend when we look at the weekly chart. The green line is above the red line, so that means we're positive, and both of them are above 20. So in the longer term, we're still looking good with our trend. We actually switched over to negative for one day on the daily charts, and then we switched back after Friday's session. We're in a weakening trending environment on the daily charts because the ADX is below its moving average. When we go into a non-trending environment is when the ADX drops below 20. But with Friday's upward move, we're seeing a little bit of an improvement in the short term. If this continues to go with more upside as far as price is concerned, we may see the intermediate term turn back into a strengthening trend. But that's pure speculation at this point. So looking at all the major indexes that we follow, the Dow was up 0.7%. The NASDAQ was up 2.3% and not at an all-time high. It still has a ways to go. It's the NASDAQ 100 with the big mega caps in it. That's the one that's been doing really well lately, and it's not on this list. The S&P 500 was up 1.2%, which did set a new all-time high. The mid caps ended up, the small caps ended up being down on the week. We measure that by the Russell 2000. We're still wondering if this January effect, is it a December effect now? Because that's when we saw all the strength. We did bounce up a little bit, especially in Friday's session, but we've got a lot of making up of ground if we're going to get back to being more positive with the small caps. So for the week, we did have a holiday shortened week. These are just some bullet points that I go through. So there was 4 trading days instead of 5. The Dow, the NASDAQ 100, and the S&P did set new all-time highs. And that's encouraging in and of itself, whether it's a blow off top, whether you can justify it or not justify it, whether you're a perma bull, perma bear, you can't dispute the fact that these indexes are confirming each other by within a certain period of time, kind of close to each other, are now setting new all-time highs. The mega caps and the semiconductors, that's where we saw the strength from both in Thursday's session and in Friday's session. And it's still continuing to outperform the broader market. Now, in Friday's session, we saw earlier strength in the mega caps and semiconductors. And then later on, as we really started to go up, that's when the rest of the market joined in. The market is recalibrating this rate cut idea. They were going with the idea that the Fed may cut rates as early as March. Well, with some of these reports coming in that are actually stronger than expected, that's thrown that into doubt. We had a member of the EU come out recently and say, no, if we even cut rates, it's going to be this summer at the earliest. And so that's kind of brought the market back down, hopefully, to a little bit more of a realistic expectation there. Interest rates were up on the week, and this is interesting. We had an up week with stocks. We had an up week with interest rates. They usually move in opposite directions, and rising interest rates quite often put stocks under pressure, but we didn't really see that. The 10-year did rise up to 4.15% with the 10-year yield. As far as some Fed speak that came out, Fed Governor Waller, who is an FOMC voter, indicated that the Fed could begin cutting rates this year. Okay, the market's already been going with that. But what kind of took the market by surprise was the big but here. He reiterated the Fed's estimate of 3 rate cuts rather than the 6 rate cuts that the market has been pricing in. That's where we're seeing this real recalibration starting to take place. Retail sales, housing starts, and jobless claims, they were stronger than expected. Retail sales came in hot, and That's a big part of the US economy. And so that is a bit of a concern as far as interest rates are concerned. Economically, it just suggests, yeah, the economy's hanging in there as far as sales taking place. And then consumer sentiment did also come in above estimates as well. And I go over that in the daily video. Earnings were being released, and it was pretty much mixed across the board. We saw companies like Goldman Sachs, Morgan Stanley, Travelers, some were up, some were down. All right, and then I've been showing this for a little over 6 months now. This is looking at a chart of inflation. And at the time I found this chart, and I have not been able to update this, and with the stock charts software that I use, I don't have the ability to overlay different time periods onto the same chart. So I kind of have to go with what I found here. This was on Twitter, or X, I guess it's called now. But for a large part of 2023, and even going back further, we were seeing inflation pretty much do about the same type of seasonality or the same type of movement from 1966 up to 1982. Well, right now we're coming down, and are we getting to the bottom of inflation? Remember, this chart's about 6 months out of date right now. We still might fall a little bit further as far as inflation is concerned. The area to be aware of is, look what happened after that. This is when we saw the hyperinflation of the 1970s. That means we had astronomical interest rates with no economic growth. That's what they call stagflation. Now, after that, it got a little bit better, but it sure was a rough ride. And if you grew up in the 70s like I did, you were well aware of this happening. Then we did close at 4.15%. This is according to some Renmac research. This is a chart that I found on Twitter, where according to what they found out, when we get above 4.02% with the 10-year yield, that's when it starts biting into corporate profits. And right now we're at 4.15%. We had dropped under that, but now we're starting to go back above it. Here are the poll results, and this is as of Friday's close on January 19th. The first question that I asked a week ago, all of the oscillators on the daily charts are below their respective moving averages, and we're still that way for right now. Our shorter term ones are showing some improvement, but our intermediate and long-term oscillators haven't changed. Some are improving, but still negative after being extreme positive. Do you feel that the oscillators will continue to fall or will turn back positive in the upcoming week? Everybody that voted said that they will continue to fall. And that's pretty much what has been happening. Now, with the bounce that we saw on Thursday and Friday, we're seeing some improvement, but they really haven't crossed above their moving averages yet. Then, does the negative divergence between the transports and the S&P bother you? 53% said yes, 47% said no. I asked kind of a similar question. Do you think at some point the market's going to have to reckon with that? Because when the transports aren't participating, sooner or later that could become an issue. I don't really know when. It could be this coming week. It could be 6 months from now if that still continues to happen. Then the yield on the 10-year back in October hit 5%. Sometimes this signals a negative event, and I have another chart to show you later of this, that is not known at the time. So when we were really spiking up with interest rates, do you think something was happening, but we may not know about it right now? And that's pretty much what I ask here. A negative event that is currently unknown, 83% think that's what's happening. Interest rates are falling for economic reasons, and you could make a case for that. We don't really know the definitive answer to this right now, and we may not for a while. The S&P seems to be stuck in a range. Now, we finally broke out of that range between the all-time high acting as resistance and the 20-period moving averages acting as support. That's what I was really honed in on this past week, were those 20-period moving averages. It looked like we might be losing them only to come back and recapture them. And that's where we saw the nice move up after that. So in the upcoming week, do you feel the S&P will stay in this tight range, break out to the upside, or break to the downside? We ended up breaking to the upside ultimately, but it was later in the week. 36% thought that's what would happen. 45% thought we would end up breaking down. And earlier in the week, it looked like that might be what's happening. And then 18% thought that we would stay in the range. And if we had closed back down without setting a new all-time high, we would still be in that range now. Then looking at some Isabel Net block charts, I only have one here. And this is updated every week, and this is looking forward as far as earnings estimates. And you can see from left going all the way over to the right, we're seeing increasing numbers, whether it's Morgan Stanley or the consensus. This is justifying stock prices going higher. FactSet had a couple of blog posts. It says the S&P will likely report year-over-year earnings growth of at least 4% for the fourth quarter. I highlighted it with a red box here. This is just an estimate for right now. It's not gangbuster, but it's positive, at least for the time being. Then this is an update, and we're just at the beginning stages of earnings season. As of this, and I'm not going to read all of this, I'll just try to hit the important parts. 10% of the S&P 500 components have reported as of Friday, and 62% of those that have reported are above, which is below the 5-year average and also below the 10-year average. When you take it all together, earnings are 18.1% below estimates, which is below the 5-year average and also below the 10-year average. Please keep in mind that this is calculated based on all of the companies in the S&P. I believe there's 505 companies now, not the actual results from the companies as they're reported. So this can be a little bit misleading, but as we see more S&P 500 companies start to report, we'll get a little bit better reading on how things are going there. Looking at our charts, first the intraday chart. We start back on Tuesday because the market was closed on Monday. We gapped lower and then we're able to come back up, but then we ended up finishing off in that session. We bounced up a little bit going into the close, and that really kind of saved us from showing more declines. We gapped lower in Wednesday's session. This was the low point of the week. We actually hit a low, but then it was more encouraging. Both on Tuesday and on Wednesday, we saw some late day buying coming into the market. That means the smart money is coming in. It's the amateurs who open the market. It's the professionals who close it. That's why I execute any new positions that are directionally based. I execute them as close to the close as possible. And I only execute them in the direction of what I want the position to do. If I'm long in a position, which means I want it to go up, I'm only going to get in if we have an up day. If I'm in a short position, I'm only going to get in that position if we're having a down day. If we do the opposite, I'm not one of these buy on dips folks. I believe in looking at the charts, developing a plan. You buy into strength, you sell into weakness. Okay, that's how I do things, which is the opposite of what a lot of people do. Then in Thursday's session, we gapped higher, chopped sideways, and then this is where we started to see a nice little run up here. It began in Thursday's session as we entered into the close. We just continued on with that upward move in Friday's session, and this is pretty positive. This is later in the day. We were able to hang on to some gains. We can't really tell if this is short covering, which means these are people that are losing money because they shorted the market and they're covering their shorts right now. It might be that way, but seeing this sideways action to me is more positive than negative because we were holding on to gains. We tried to go a little bit up, a little bit down, but when we finished, we ended up closing pretty much at the high in Friday's session. So, and this is just the 4 trading days for the week, it's not a whole week. Where the NASDAQ 100, the NASDAQ, and the S&P were up the most. Then we had all of the other indexes that we follow, the Dow, the mid caps, small caps, and the NYSE. All of the indexes ended up being positive. And this is going back to the beginning of the year where we have everything, well, not everything. The NASDAQ 100, NASDAQ, and S&P are positive, followed by the Dow, where we still have the NYSE. That's a broader measure. We have the mid caps and the small caps. They are still negative going back to the beginning of 2024. I don't have the all-time high anymore because we set a new one. Looking at our sectors, we had an up week, so that's how I sort this. Tech and communication, these were the strong areas in 2023. They ended up leading things higher. The financial sector, after getting kind of hammered a week or so ago when we had some earnings come out, well, it showed a bit of a bounce. And then on the bottom, materials, real estate, energy, and utilities ended up being down. These are more defensive. These are more interest rate oriented type of plays. Then looking at our relative rotation graph, and I try to remind you from time to time, if you remember back to your geometry class, when you had to deal with an x-axis, that's the flat line, and a y-axis, that's the one going up and down. When we're on this side of the y-axis with the x-axis, this is a plus. So this area up in the top right-hand corner, that's plus plus. And when we look at all these sectors in the S&P 500, we have real estate, which has been bouncing back up because interest rates had been falling. The financial sector, which was under a lot of pressure earlier in 2023, it's been coming back. And then also looking at tech, where these are the strongest areas. I go back 1 year and then I rate them according to their industry sector. We are seeing communication show some weakness, and we're seeing energy just it can't get any more left than this or any more down than this. Energy has really been under some pressure lately. Some other areas are showing some improvement as well, but we mainly focus on what is really strong, what is really weak, and then what has been changing. Here are the sectors, and this is just for the 4 trading days, where we had tech and communication were up, financials were unchanged. All of the other sectors ended up being down, even after Thursday and Friday's advance, showing that the mega caps did outperform. Going back to the beginning of 2024, we have tech and communication doing the best. All of the other sectors are negative so far. Keeping an eye on sentiment, we did come in with a reading at 72 after Friday's session. This is a historical chart where we got up to about 80 here. We were looking extreme positive as we were ending 2023. We started to fall back down, then we came back up, fell back down. So we're getting kind of a roller coaster run here. And a lot of times when we get above 75, not a lot of times, all the time, when we're above 75, we start to look at using this as a contrarian indicator. This means that folks are very, very happy right now and they think the market's going to do nothing but go up. That's when we're too exuberant and we started to come back down. Because we had the up days on Thursday and Friday, we're seeing sentiment improving, but we're not extreme yet. Here are the active asset managers. This is anywhere from 1 to 2 weeks old, where they had become extreme positive right at the end of 2023. Now they're showing more pessimism. This will likely go up in the next reading because we finished at an all-time high and had an up week. This is another look at that same chart. We ended up closing at 53.54. Keeping an eye on a weekly chart of the VIX, where we were getting to a very low reading here. We were starting to bounce back up on the line chart. We're also in a very low range with the bar chart. Here's the Ulcer Index, which continues to fall as prices have been going up, showing that there's not a lot of fear. This is the Ridex Bear Bull ratio. When this is going up, folks are in bearish funds. And Ridex does have mutual funds that go up in value when the market goes down. I used those for years. They also have bullish funds that are based on the S&P 500. They also have what are called enhanced or juiced mutual funds, where if the S&P goes up 1%, that mutual fund will go up 2%. There are also ETFs that do that same thing. I was using Ridex mutual funds before the real craze in ETFs started to take off in the late 90s, early 2000s. But right now, we're getting a pretty low reading. That means that the folks that do this kind of investing, they're pretty positive on the market right now. And you could make a case that we're getting rather extreme. Now, there's a 1-day lag on this chart. This is Thursday's close, so we won't get Friday's close until Monday. And looking at the latest reading of the American Association of Individual Investors, they're more positive, and we're seeing this red line, the moving average, start to go up, but they're not giving us an extreme positive reading. That may go up quite a bit in the next reading because we hit the all-time high with the S&P. This goes contrary to what you might think. When this black line is going down, that means the tech sector is outperforming cash, where cash outperformed in 2022, but then started to show some real improvement in 2023, and it's continuing to do that in 2024. Here's some economic charts just to keep them in mind right now. We are going to get another read on GDP. Right now, the GDP estimate, which tends to be rather optimistic, it'll often be higher than what GDP actually is. We're coming in at about a little under 2.5% right now. When you look at the forecasts out there, on the top, we're at about 2.5% or so, and we're down maybe 0.75%, maybe 80.8, something like that. That's the overall range. This is looking at this on a bar chart. What I take away from this the most is you look at all of these and they're positive. One part of being in a recession is when we have negative GDP for 2 consecutive quarters. we're not seeing that yet. Now, there's other charts that we look at that show that we're going to go into a recession. There's even other charts that show we're not, and that's part of the debate that continues to go back and forth. This is a spread between risky bonds and not as risky bonds. We get concerned when this really starts to spike up. This continues to go down. Then we're looking at every week we get a reading called the Chicago Fed National Financial Conditions Index. This has to be a Fed chart. It has an astronomical name. They can't come up with something short and sweet. But we get nervous with this chart when we go above the black line. We're declining and below the black line. This has not been updated since the first part of November. These are tightening standards for banks. This was updated a little over a month ago now. Well, not quite a month, just January 5th. We get nervous when this goes above the red line. We are above the black line, but we're actually coming back down, and we're not going above the red line yet. Also updated on January 2nd is the smoothed U.S. recession probabilities. We get nervous if we go up to the red line. We're barely above the black line. And then the Brave Butters Kelly leading index. This was updated at the end of 2023. That's what I usually say about government charts. You go to Fred, which is the Federal Reserve. They let you access all this data. These charts are awesome and wonderful and tell us exactly what we should have done, but they're about 6 months to a year too late. So by the time we actually see this on the charts, what we needed to do already happened. Keeping an eye on inflation every day. This is a thing called the inflation nowcast, and it readjusts. We're going to have PCE and core PCE coming out later this week. So these might adjust a little bit as we get closer to that day. Keeping an eye on the Fed. As of right now, Friday's close, there's a 97.9% chance that at the January 31st meeting, the Fed is going to leave rates unchanged. Where are we? Well, I'll show you that here in just a moment. And the market is pretty much settling on that. We see this dark blue area. That's where we're at now. Day ago, week ago, month ago. And that's pretty much the conclusion the market has reached. This is where we see some variables. The market thought that maybe at the March 20 meeting, that would be the first rate cut. And we're really seeing this start to change, where we were seeing the percentage really high at a 25 basis point cut. Now they're starting to shift over to seeing interest rates unchanged. To give you some historical perspective, we were a lot more convicted with the 25 basis point cut, but then a day ago, and then the current reading right now, you can see how this is really dropping down. Here's the Fed balance sheet, just showing you how it has been declining. This is the year-over-year look, where it's turning back up a little bit, but it's still negative as things fall off the Fed balance sheet. Here is the advanced decline line with the weekly chart. We're looking positive based on price, even though we're flattening out. We're turning down just a little bit based on volume, but we're still above the moving average. And with our new highs, new low studies, we're starting to roll over a bit with our 4-week moving average. We're pegged at the top on the daily chart. It can't go any higher than where it's at right now. And if you look up here, you see that the new highs are really, really outnumbering, and you can barely see the new lows. Where we had been declining with our 10-week moving average, we're starting to flatten out now. Here's an advanced decline ratio. We're above 0 and advancing with both the blue line and the red line. That's positive. This is a smart money indicator, and we're also looking positive on the daily chart. This is called accumulation distribution. When we're above this moving average and going up, that means the smart money is accumulating. They're buying. When we see this going down, that means the smart money is distributing or selling. And so we like to follow this pretty closely. Here's our trend with the ADX. That's the dark black line here. That's the main indicator. I put a moving average on top of that just to give us some sense of direction. We're above the moving average and we're above 20. So that is a trending environment in the long term. We're seeing a weakening trend on the daily charts. The green line is on top, and so we would default to positive. So based on this chart, we are in a positive trending environment. Here's the Erin indicator, where this tries to measure buyers versus sellers. When the green line is on top, that means more people are buying. When the red line's coming down, that means fewer people, or more, I guess you'd say more people are selling. And then the difference between the two is the oscillator. When we're above 0, that's positive. Below 0 is negative. We're above zero and advancing. We're seeing a bit of an extreme reading on the daily chart right now. We're getting pegged near the top. The mass index is not generating a signal right now. Here's the daily chart where we finally broke above this gold line that I had here. Mine was a little bit different than other charts you may have seen or charts that you may use. I was basing this on the intraday high, where most other charts base it on the closing high that we set in January 2022. We were able to get above that and close above that. Now we're wondering, is this a fake out? Are we going to come up here and then come back down? Is this the beginning of something where we're going to continue to move higher? We just have to watch this day in and day out to try to reach those conclusions. The trend channel shows that we're above the midpoint. That's when we are more positive, going back to 2009. And we broke above this other pivot level. This is where we topped out in July of 2023 and then ran into problems. We broke above that and we're continuing to move higher. So this chart is looking positive. On a trending basis, looking at a 50-week simple moving average, we're going up with the red line and prices above both, or prices above the moving average. So that is positive. The long-term trend uses a crossover system where we have the blue line above the red line and prices above both. So we are looking positive there. We're starting to turn back up a little bit with the McClellan oscillator. This is somewhat negative for right now, but we had been working off of an extreme reading. We want to see this turn and go back up and eventually cross back above zero to turn more positive. And then based on whether the McClellan oscillator is positive or negative, that's the summation index, where we had become very extreme positive and we're starting to come down, and we have not dropped below this level yet. We've already been coming down based on volume, and I've been trying to point this out in the daily videos. You notice how we decline with price. Notice how much bigger the line is when we look at the decline based on volume. That's what we've been seeing. Volume has been outpacing price. There were other times earlier in 2023 when we saw volume outpacing price, and then we saw some real solid up moves after that. It'd be nice if we could get back in that kind of a situation if you're positive on the market. We're still below zero based on price and volume when we look at a weekly chart of the Swenlin trading oscillator. So that's a little more negative. And we're coming right back down. We're just a little bit above 70 with the bullish percent index. We had been coming down, but with Thursday and Friday's up move, we're seeing this tick back up just a little bit. Then here's the PMO. This is trying to measure the momentum on a weekly chart. We're going up with the PMO. Then we break that down into price and volume, where we're declining based on price and volume, but both are still above zero. And we have some PMO studies that are attached to the PMO indicator. We're turning back up with the PMOs that are rising. We're starting to get extreme negative with the buy signals. We're still extreme positive with the PMOs that are above zero, seeing kind of the same thing now on the daily charts. The Bollinger Bands are up on top, where on the daily chart, we closed outside of the upper Bollinger Band. But here on the weekly chart, we're still inside of the upper Bollinger Band. The fact that we're above the midpoint, that's positive. And the fact that the line is actually going up, that's also positive. Here are our different oscillators. We're still positive and getting extreme with the slope. We're looking positive and not extreme with the TSI. That's the short term. Then we have three of our intermediate term oscillators: the MACD, the PMO, and the PPO. They continue to be positive. Then we have two long-term oscillators, the TRIX and KST. They continue to be positive and they're starting to get extreme. That's a bit of a warning sign. The chicken money flow is looking a lot better on the weekly chart than it has been on the daily chart. We've been positive on the daily chart, but we've been declining. Now we ticked up a little bit on Friday. The fact that this is going up, this is another smart money indicator, and we want to keep an eye on this. If this is going up, that means the big smart money is actually buying. The chicken oscillator, after getting extreme positive back in late 2023, it has been falling. Now it's starting to turn back up. The force index is above zero and it's green, so that's positive. We're still extreme positive with the money flow indicator. I used to call it the money flow index, so I get tripped up. The 1 week rate of change from this week versus last week, we were positive, but not as positive as we were the week before. The rate of change going back 50 periods is continuing to decline after giving us an extreme positive reading, but there are times when we could have gone a lot higher than this. I put these lines on here myself, and I just kind of eyeball it and say, okay, where are the majority of the spikes right here? Realizing that in early 2021, we really spiked up, and that was more of an anomaly. Then looking at the RSI based on 14 weeks, we are above 50 and advancing and not extreme. That's positive. The weekly special K chart is starting to turn back up, but we're still below the moving average. The daily special K chart is still positive. The Stochk RSI is extreme positive. The Williams percent R is also extreme positive. The ultimate oscillator, after being extreme, fell back. Now it's starting to turn and go back up, but this is still positive. The vortex is coming down with the green line, coming up with the red line, but we're positive here. We saw a switch in the vortex. It had gone from being positive over to negative. Then, after the solid move that we saw in Friday's session, the vortex on the daily charts have now switched back over to positive. The Copic curve on a trending or momentum basis still continues to go up. And that's what we see here. But we're still continuing to go down on the daily chart, even though it's showing some improvement. Now, I'm going to have to redraw this at some point because this was based on the previous all-time high. Now that we've come back and set a new all-time high, I'll need to redraw these Fibonacci lines at some point when something makes itself known. We also follow these moving averages, the blue and the red. Then this is an ultra long 200-week moving average here. This is the very, very long-term trend, and we continue to go up. Our different charts looking on a weekly basis, the Heiken Ashi is still looking positive. The Kegi chart is positive. It's black and pointing up. The Renko chart is positive, and the three-line break is positive. So different types of charts that measure trend are all positive on the weekly charts. They're improving on the daily charts. We're rolling over a little bit with the 14-week ease of movement indicator, but we're still above zero. We didn't see anything new drawn. I kind of thought when we hit that all-time high here that we would draw in a new X, but that didn't happen. But this is still looking positive. We're still working off of the latest signal that was generated on November 20th, which was a double top breakout. And then looking at the trend using the Elder's Impulse system for the S&P, we've gone from being neutral a week ago, now back to being positive. The parabolic SAR is positive on the daily chart. It's also positive here on the weekly chart. That means the dots are underneath. Here are some momentum studies in the long term. We're going up. We're turning back up in the intermediate term. We're also showing some improvement in the short term. Now, this is a weekly chart. So short term, these different time frames are kind of relative. Then I go through the daily slides because I know all of you don't watch the daily videos. And I try to pick out some charts that I'm really focused on that you might find interesting. This is the Decision Point scorecard. Decision Point is connected to stockcharts.com. And they have a trend model system and then a PMO. The person who runs Decision Point, well, he's kind of retired now. It's more of his daughter. He developed the PMO, the price momentum oscillator. And then this gives the date of their latest reading. Then this is what I've been really following. I'm a big growth versus value analyst, okay? When the blue line is above the red line, that means growth is outperforming, even though they're on different scales. When we were underperforming here, that at the beginning of 2024, this is when we saw some real problems. When we saw growth turn and go back up, and also this is a 10-minute intraday chart. When this started to go back up, that's when we started to see things improve. Then we had a little bit of time here where it went down. Now it's starting to go back up. So in a more positive environment, we want to see the blue line outperforming the red line, and both of them, both can go up, but we really want the blue line to go up. Here's an end of day chart looking at growth versus value for the S&P. Also, right around the 8th of January, we seem to have bottomed here, and we've been showing some consistent improvement ever since then, and that's really been supporting the market. Then looking at the small caps. Now, this is an end of day chart where we're getting closer into the top end of the range. When we look at small cap growth versus small cap value, you can see while the index was really going up, experiencing the December effect, we weren't seeing that really being combined with an outperformance of growth versus value. Now it's starting to pull back down, even though we still are seeing some improvement with this ratio. The mid caps are holding up better, and they're actually breaking out, and they're not as range bound currently, and they're in a more of a positive uptrend. And as this was going up, we were seeing a general upward move here. If we could continue with this, we should see some improvement with the index. And this is the most important one for me personally. This is the growth to value ratio for the S&P on an end of day basis. We do have a recent death cross here, but we are showing some improvement, not only on the intraday charts, but here on the daily chart as well. And then here's another study where we compare growth versus value. This is starting to break out and we're above the rainbow. So that's positive. One area that isn't discerned is discretionary. On the top, we have the S&P. Then we have an equal weight ETF of discretionary. And this has really been underperforming, even though it was up on Friday. Staples have been doing quite well lately, only to see some weakness. The most important part of this chart is the ratio on the bottom, where we were going up really strong with the S&P 500. We went up a little while, but then we started to fall back down. This was a negative divergence. We want to see discretionary outperforming staples to be more positive on the market. It's improving, but it's not there yet. And then here's the 20-period moving averages. I plot both a simple and exponential moving average. Simple means they're all calculated the same each period. Exponential means that there's more weight put towards more recent prices. And so I plot both of them because there's the debate that goes back and forth which one is best. When we were coming down, we actually came down and it was the exponential moving average that held, and we bounced up. Then we saw some more weakness. The exponential moving average bounced again. And this might be a little bit by design because most people use simple moving averages, not exponential moving averages. And when we started to break below the simple moving average, you had a lot of people just immediately going short at that point, 2 times, only to have the exponential moving average come in and actually have the support hold. And then so far we've been bouncing up off of that. This is another concern. The Dow is setting all-time highs. The transports are not, and they're not even back above this previous high. Now, I also include utilities, but the fact that they're declining is actually supporting the S&P. Here is a seasonality chart. We're in January right now, where we tend to be up 40% of the time with a return of 0.2%. When you look at 2020 through 2024 so far. And then this is just a plain chart of the S&P, the mid caps and the small caps. We are finally making a new high with the S&P. We still have a ways to go with the mid caps and even further to go with the small caps. The Dow is in an uptrend and setting a new all-time high in an overall uptrend. The NASDAQ still has a ways to go to get back to, what is that, 16,000-ish? And right now we're at 15,300 or so. So, I mean, it's positive, but it'd be more, for the broad market, this would be more positive if this could go up and set another new all-time high. The NASDAQ 100 is setting new all-time highs and is in an uptrend. Here's a weekly chart showing how we did end up setting a new all-time high with the weekly bars. The mid caps are showing some improvement, but then starting to come back down. We're still in a longer-term uptrend with the weekly chart. We're still in an uptrend with the small caps, but we went up in December, and then we've been giving most of that back, even though we did see a bounce a bit on Thursday and more on Friday. The NYSE, this is another broad market measurement, continues to be in an uptrend. All stocks are also in an uptrend. That's U.S. as well as international stocks. The 30 biggest software companies, they're still above the moving averages and starting to turn back a little more positive. The FANG index, this is Facebook, Amazon, Apple, Netflix, Google, and a bunch of other ones. These are the mega caps, and they're the ones that are really performing the best right now. But be aware of that. In 2022, these were the ones that were going down the fastest. Then the ARC didn't really have a good week. It's still on a longer-term uptrend, but now it's starting to come back down. Looking at a weekly chart of the KBW Bank Index, we are showing some improvement here with the momentum, even though it's rolling over a bit. We're coming down after being extreme positive with the RSI. And the deposits either going in or coming out of banks, it continues to show net outflows, meaning people are taking money out of banks. Here's just a plain vanilla look at Dow theory, where we're setting a new high with the Dow. We have quite a ways to go with the transports yet, and that's a negative divergence. The fact that the utilities are going down is helping stocks right now. They're tending to go down when interest rates go up and vice versa. Looking at the broad market, these are commodities, and I have the breakdown here on the chart. We are generating a death cross here, and we're going negative on the daily charts as well. Oil is just kind of bouncing around, 70 to the downside, 75 to the upside. Copper, still a little confused right here. It's pretty much going sideways. You could, the old, I'm not a big triangle person, So you could draw some kind of a triangle in here. I've seen them, say, oh, we're going to go up, or we're going to go up and then roll down, or we're going to go down. I've seen these patterns fail as much as I've seen them succeed. That's not good enough for me. I would just rather look at the charts themselves. Here is a weekly chart of the dollar where it has been bouncing back up, but it's still in a longer term downtrend. Gold is still in an uptrend, even though it's been pulling back. Silver is trying to cross over here positive, but it also has been pulling back. Then keeping an eye on the price of bonds, we're looking better with our world bond ETF weekly chart. And stocks continue to outperform bonds, even though bonds are improving. And this is the 1 month yield subtracting the 3-month yield. This should always be negative. For quite a while now, we've been getting a positive result. And I'm wondering, is this some kind of a warning sign that maybe somewhere down the line we're going to find out why? The other time this really gyrated, that was during the debt ceiling crisis. Now, they did pass some kind of continuing something in Congress to avoid a shutdown. Maybe this is it. Maybe this is going to get back in line in the upcoming week. But I've been watching this for about a month now, and it's not logical. We are seeing a general decrease in interest rates when we look at all the different maturities, but lately they have been bouncing back up. Here's a weekly chart showing the US, UK, and German rates are going back up. Japanese rates are also turning up. That is the red line. I included this, and this is a historical chart. When we topped out at 5%, now if we go to high 5% again, this chart is going to be outdated. But when we hit 5% and started to come down, you notice other times when we spiked and came down, this was usually something bad that happened along the way. The variable here is we don't know where is this a legitimate spike? Is it going to go back up and make an even higher spike? We don't know that right now. We can look in hindsight and go, oh yeah, we should have done this, should have done that. It's a lot more tricky and a lot more challenging to try to uncover this in real time, where the right part of the chart hasn't been drawn yet. Some relative studies, this is going back to the beginning of 2024, looking at intermarket analysis. So far, we have oil in the lead, followed by the dollar, and stocks are now positive for the S&P. Gold is negative, and the price of bonds are negative. Then looking at a ratio between the NASDAQ 100 and the S&P, both just set new all-time highs, but the NASDAQ 100 is outperforming. The S&P 100 is really improving compared to the S&P 500. That means the bigger stocks are outperforming the rest of the S&P. Growth is showing some improvement here when we compare it to value. We are in an uptrend, but we want to see this really move up to turn more positive. And gold is underperforming the S&P because the S&P has been going up as gold's been going down. And we were coming up to this trend line when we compare gold to the US dollar. We hit this blue line, and this blue line's been here for a few years now. And we hit this, and now we're starting to come back down as the dollar was bouncing up as gold has been going down. Bonds still continue to underperform stocks. That's why this green line is going down. And when we look at low volatility stocks and compare them to the S&P, this is also underperforming. Low volatility stocks held up better in 2022. They didn't do so good in 2023. 2024 is still an unknown. Discretionary to staples. This is a concerning area. Yeah, discretionary is still outperforming on the weekly chart, but we want to see it do better than it has, especially on our shorter term charts. Then we take a ratio between the energy sector and the tech sector, showing how energy is underperforming tech. Then we have some secular and cyclical trend studies. Secular can mean decades. These are that 200-week moving average that I showed on the Fibonacci chart. That's a secular measurement right there, where cyclical is more years. And we went through more of a cyclical bear market in 2022, and then we hit bottom and we started to come back up in 2023. So we look at the NYSE breadth thrust. There was a signal generated in October 2022, and this is still indefinitely on the books. The ZWAG NYSE breadth thrust. It's very rare to see any of these signals. We saw 2 in less than a year. This is also indefinitely on the books. The Zoharchak, this did change back. When we were running into some problems last October, we got all the way down to a -6, and this doesn't change all that much. Well, when we started to bounce back up, we got up to the 0 level. That means we went from being negative to neutral. That's an improvement. And then this past week, we've shot up to a full-blown buy signal now. So this is long-term positive. Also, long-term positive is a weekly chart going back to the 1987 crash. And we're just a little bit above this trend line now. This is a shorter breakdown, just going back to 2018, showing how the S&P is above this weekly trend line. And this is a newer study, and I'm going to probably just start showing it in the weekly video unless we see some real changes. This is the new highs minus the new lows for the NYSE. And then we take a 50-period moving average of that. So I actually have the NYSE indicator invisible here. When we're above zero and going up, that's positive. You notice how in 2022, we spent pretty much the whole year negative, and we blipped back up a few times in 2023. Now, if we can stay above this, that would be longer term positive for the market. Here's the NASDAQ 100 weekly chart going back to 2009. We're starting to break above this trend line. Now, a lot of the perma bears, the people that no matter what's happening, doom and gloom and life as we know it is just about ready to end. This is what they've been saying for 20 years now. They picked up on this chart and they think this is the answer to everything, where now we're starting to break above that answer to everything. Now, it could change, but for right now, they're looking pretty foolish. And then we take a ratio of the NASDAQ 100 to the Dow. We're starting to come back up to these previous levels. This was the dot-com boom when we spiked. Going down, that was the dot-com bust. We came back up in late 2021 and spent a lot of 2022 under pressure. We've been coming back and we haven't quite got back up to this extreme reading. When we hit that, what's going to happen? Are we going to blow through and keep going up? Is this going to be resistance and come back down and pressure the market? These are the things that we're just watching for, even though we don't have answers to them right now. This is a ratio of the Qs to the small caps, where we did spike up in 2023, started to come back down. Now that we're seeing things improve a little bit, we've been going back up with this ratio. This is another area that's very long term. This is the cumulative new highs, new lows for the NASDAQ. We spent years declining with a little bit of hope along the way. We're starting to turn back up. Now, this is going to take a long time for this to develop, but we are turning back up, and that is positive. We're just a little bit below zero when we look at our new highs minus the new lows. This is our raw score for the NASDAQ. And then we're also keeping an eye on this. We don't know if this is telling us something or not. This is the 3-month yield. It topped out in 2007. After that, we had the great financial crisis. We've gone above that, and we're starting to come back down. Is that meaning something to us? Right now, we're just watching this. And I've been watching this for quite a while, so it's going to take some time for this to play out more. So this is just for Monday's session. This is the conclusions that I've reached. Is the January effect over? Yeah, we bounced a little bit this past week, but we're still negative with the small caps. Where was it the December effect now? And we won't know the final score for our trifecta until the end of January. The Santa Claus rally was negative. The first 5 trading days were negative. If January ends up being negative, we're going to be 0 for 3. Technicals are positive and showing some improvement at the same time. This past week, we were able to regain the 20-period simple moving average. On Monday, we will get existing home sales as well as consumer sentiment. And we just want to keep an eye on what's happening here, because at some point, the market may look at this and go, either in a good way or a bad way, and the market could end up bouncing or declining because of that. Here's the upcoming economic calendar. The big day is going to be Thursday when we get durable goods. GDP, this is another update of a reading that we've already seen. Unless it's really, really different, it may not have much of an impact. And then the other big inflation report is going to come out on Friday. Looking seasonally, and this is just for Monday's session, January 22nd, we're negative with the Dow. We're neutral to negative with the S&P and the NASDAQ. And we're coming in now to the week after options expiration, where we tend to be more positive than negative. Then this is an updated chart from Carson, where the green, this is what's happening so far in 2024. This is historically, they've kind of crammed it all together and created a composite, where we tend to see some weakness before we see strength later on in the year. We will be on the 14th trading day of the month, where we do see a little bit of a bounce here with the S&P. You could also read a little bit of a decline into that. It's kind of hard when these lines are on top of each other. And we're wondering, where are we, if anywhere, here in the January effect for the small caps? And we're also chopping sideways here with this other research chart, where we do chop, and then all of a sudden we see some weakness before we see some strength. Then here's the Stock Traders Almanac statistics. We follow the green dashed line, which tends to be more flat. we see some weakness before we see some strength. Here is when the sitting president is running for re-election. We're not really sure if that's going to happen or not, but that's the intention so far. And we're not really seeing the positive seasonality that normally we would see when we have this kind of a situation. Then we will be on Monday. On Monday, we'll be on the most positive trading day of the week. Even though seasonally we're looking negative, when we look at 2023, Monday ends up being up 67.3% of the time. And then this is a chart, I'm not really updating this yet. Somebody went in, because there are people that like to try to find what's already happened and match it up with what's happening right now. I think it's interesting. I like to look at that, but I don't base decisions around that. Back in 1982, we were declining and then we started to bounce up. In 2023, we were declining and starting to bounce up. What happened after that is we saw some strength going forward. Is that going to be what we see this time? And then going back to 1950 during an election year, the S&P is up and down both 50% of the time. It's a wash. So our scenarios, can't really go with the down one yet on the daily charts. If anything, we would lean more to the positive side, but we're overbought. And we're getting a little extreme there. So I haven't highlighted that. But we're not going with the sideways trend now because the ADX, both on the short and intermediate term, continue to be above 20. So the warning signs, the risk on posture it's ticked up the last couple of days, but it's still going down overall. The transports are still diverging from the Dow. That's, to me, is longer term negative. The 1 to 3 month short-term bond spread continues to be positive where it should be negative. The copper curve is negative, but it's starting to turn back up. Our oscillators, some are showing some improvement. Some are still rolling over and dropping below their moving averages after being extreme positive. Some long-term signs. The weekly chart for the NASDAQ 100 and the S&P, we're near that. We're actually breaking a little bit above that right now. But this could act as longer-term overhead resistance, even though we may go up above it for a while. The 3-month yield is above where it was back in 2007, right before the great financial crisis. And then earnings are either positive or negative, and it's on a case-by-case basis. We are seeing some improvement here with growth, and that is encouraging. And when we started to see that, that's when we started to see stocks show improvement. Our daily special K chart is positive. Our weekly chart is still negative. And I can't really update this right now. The charts, even as I recorded this over the weekend, those charts haven't been updated yet. But the last we saw, our 5-period equity put call ratio is going down. That's positive for stocks. Longer term, we are also declining with 253 periods. The parabolic SER is positive. The vortex is now, this should be switched back over positive. It's not negative, it's positive. And the bullish percent index for the S&P and NASDAQ 100 are both positive and extreme positive. They're both above 70 now. The Zohorchak method just kicked into a full-blown buy signal. The NASDAQ 100 momentum is starting to turn over positive. And we're still working with golden crosses recently with the Russell small caps and mid caps. Small and mid cap growth, I showed you those charts. They are chopping sideways with mid caps actually showing a little bit of strength. The financial sector, after a week ago, getting hit a little bit, starting to bounce back. And our new high, new low study based on 50 periods for the S&P, it's still above zero. And that's the important thing, even though it has been declining lately. Long-term positive signs. We did see 2 ZWAG NYSE breadth thrust signals that were generated over the last year. Seasonally and historically, January, sometimes it's good, sometimes it's not so good. So not really sure what to say there. The cumulative new highs, new lows for the NASDAQ are improving. They're starting to turn up, but this is very long-term. Seasonality and setups and some of the charts that I showed you, those are still deeper in the background and are still positive. So our conclusion for Monday's session, we're positive and showing some improvements. We have some overbought indications in the short term. We have a little bit longer list in the intermediate term. We are overbought in the short term, but showing an improvement. Intermediate term, we have some overbought indications and even a couple of oversold ones. And long term, we still remain positive, even though we have 2 moving averages based on 150 and 200 periods that are still overbought. Thank you. I really hope you found this helpful. Please feel free to check out the daily video. After this, I will be preparing the intermarket analysis video. And then the last video I do each week is the deep dive video. Have a really good weekend, and I will talk to you in the next video.